Picture this. While everyone else was chasing the latest AI hype in 2023, a small group of shrewd investors quietly accumulated dividend stocks that went on to deliver both substantial income and market-beating returns. Today, we're standing at a similar crossroads for 2025, and I'm about to show you why these 10 dividend powerhouses could be your portfolio's secret weapon in the coming year. Here's a shocking truth that Wall Street doesn't want you to know. Over the past 50 years, companies that consistently grew their dividends didn't just survive market crashes, they thrived through them. And right now, we're witnessing a rare market inefficiency where some of the highest quality dividend stocks are trading at puzzling discounts, despite boasting rock-solid financials and growing cash flows. Think about this. What if you could own a portfolio of elite companies that not only pay you growing dividends, but also offer an average analyst projected upside of over 20%? We're talking about industry titans with combined market caps of over $6 trillion, yet trading at valuations we haven't seen in years. From healthcare breakthrough leaders to AI infrastructure pioneers, these companies are sitting at the intersection of income and innovation. But let me be crystal clear. This isn't another generic dividend stock list touting the same old high-yield traps that eventually cut their payouts. Each company I'm about to reveal has passed my stringent three-pillar analysis: fortress-like free cash flows, unbreakable competitive moats, and clear catalysts that could send their shares soaring in 2025. We're looking at businesses with free cash flow margins between 20% and 40%, the kind of financial strength that lets them raise dividends even during economic storms. What excites me most about these 10 picks is their positioning in sectors undergoing massive transformations. Imagine owning a healthcare giant that's not just paying you a stable 3.78% yield, but is also revolutionizing disease treatment. Or a tech leader that's quietly building the infrastructure powering the AI revolution while growing its dividend for over 20 consecutive years. In the next few minutes, I'll break down exactly why these 10 companies deserve a place in your portfolio, with precise entry points and growth catalysts that could supercharge your returns in 2025. Whether you're planning for retirement or building generational wealth, these dividend aristocrats of tomorrow offer something increasingly rare in today's market: the perfect blend of safety and explosive growth potential. Let's dive into the analysis and discover why 2025 could be the year these dividend powerhouses break out. Before we dive into these game-changing dividend stocks, take a second to hit that subscribe button and notification bell. Number 1. Microsoft Corporation MSFT. Let's kick off our powerhouse lineup with a tech giant that's not just dominating today's market, but actively shaping tomorrow's technology landscape. Microsoft Corporation, with a staggering market capitalization of $3.3 trillion, Microsoft isn't just a tech company. It's an empire that's built on innovation and consistent shareholder returns. Here's what most investors are missing. While everyone's talking about Microsoft's impressive 21% stock gain over the past year, they're overlooking the company's incredible operational performance. The numbers tell a story of not just growth, but dominance. In just 3 years, Microsoft has grown its revenue from $168.1 billion to $211.9 billion, showcasing their ability to scale even at massive size. Their operating income has surged from $83.4 billion to $113.1 billion, the kind of numbers that make other tech giants envious. But here's where it gets really interesting. Microsoft isn't just growing, it's becoming more efficient with scale. They're maintaining phenomenal operating margins of 44%. And here's the kicker. They're converting 29% of their revenue into pure free cash flow. That's not just impressive. That's financial engineering at its finest. Let's talk about their dividend story, because it's remarkable. While many investors might overlook Microsoft's seemingly modest 0.7% dividend yield, they're missing the bigger picture. The company has quietly built a 20-year streak of consecutive dividend increases, with a robust 10% 5-year dividend growth rate. Think about that. They're not just paying dividends, they're growing them at a pace that far outstrips inflation. Looking ahead to 2025, the story gets even more compelling. Analysts project earnings per share of $15.30, putting the stock at a forward PE of 30, notably below its 5-year average of 34.7 times. With analysts setting a 12-month price target of $500, suggesting an 11% upside from current levels, Microsoft isn't just offering dividend growth, it's offering a compelling value proposition for total return investors. What truly sets Microsoft apart in the dividend landscape is their unique position at the intersection of three massive growth catalysts: cloud computing, artificial intelligence, and enterprise digital transformation. Their Azure cloud platform continues to gain market share. Their AI integration through OpenAI partnership is revolutionizing their entire product suite, and their enterprise software dominance gives them unmatched pricing power. This isn't just a tech company. It's a cash-generating machine that's perfectly positioned for the next decade of technological evolution. Number 2. Taiwan Semiconductor Manufacturing Company (TSM). Speaking of technological powerhouses, let's dive into what might be the most strategically important company in the world right now. Taiwan Semiconductor Manufacturing Company (TSM). With a massive market cap of $850 billion, TSM isn't just another semiconductor company. It's the backbone of the entire digital revolution we're experiencing. Here's what's absolutely fascinating. TSM has delivered a staggering 97% return over the past 12 months, yet many investors still don't fully grasp why this company is so crucial. Think about it. Whether you're betting on NVIDIA's AI chips, Apple's iPhone processors, or Broadcom's next-generation semiconductors, you're actually betting on TSM. They're the master craftsmen behind the scenes, manufacturing the most advanced chips for virtually every major tech company you can name. The numbers tell a story of extraordinary growth and execution. In just 3 years, TSM has catapulted its revenue from $48.9 billion to $81.6 billion. That's a phenomenal 67% growth. But here's what's even more impressive. Their operating income has surged from $20 billion to $35.6 billion during the same period. We're talking about a company that's not just growing, it's scaling efficiently with industry-leading operating margins of 44% and remarkable free cash flow margins of 31%, the highest in their history. Now, let's talk about what most dividend investors miss about TSM. While its current 1.2% dividend yield might seem modest, it's backed by rock-solid financials and the company's position at the epicenter of the AI revolution. Yes, the 3% dividend growth rate might not sound explosive, but consider this. TSM is currently investing heavily in expanding their manufacturing capabilities to meet the insatiable demand for advanced chips. This isn't just about today's dividends. It's about positioning for tomorrow's technological demands. Looking ahead to 2025, the valuation story becomes compelling. With projected earnings per share of $9.50, the stock trades at a forward PE of just 22.3 times, significantly below their 5-year average of 25.2 times. Even more intriguing is their PEG ratio below 1, suggesting the stock is undervalued relative to its growth rate. Analysts see this too, with a consensus price target of $232, implying a 15% upside from current levels. Yes, let's address the elephant in the room: the geopolitical risks with China. But here's what many investors miss. These risks have created a unique buying opportunity in a company that's absolutely essential to global technological progress. The world's most advanced semiconductors can't be made without TSM's expertise, and that's not changing anytime soon. Major economies are now actively working to secure and diversify TSM's manufacturing footprint, potentially reducing long-term risks while maintaining their technological edge. Number 3. Eli Lilly LLY. Moving from tech to healthcare, let's talk about what might be the most exciting story in biotech right now. Eli Lilly LLY. With a massive market capitalization of $710 billion, Lilly isn't just another pharmaceutical company. It's become a healthcare powerhouse that's literally changing the way we think about treating chronic diseases. Here's what makes Lilly's story absolutely fascinating. While the broader market struggled, Lilly has surged nearly 35% over the past 12 months. But here's the plot twist. It actually pulled back 20% from its September highs of $972 per share. For smart dividend investors, this isn't a warning sign. It's a rare opportunity to get in on what might be healthcare's biggest growth story of the decade. Let's dive into the numbers, because they tell an incredible story of transformation. What Lilly has achieved is remarkable. They've grown their operating income from $7.8 billion to $14.9 billion over the trailing 12 months. That's nearly doubling their operational profits. But here's what's even more impressive. They're maintaining stellar operating margins of 36%. We're not just talking about growth at any cost. We're talking about highly profitable, sustainable expansion that's creating real shareholder value. Now let's address what most dividend investors might overlook about Lilly. Sure, the current 0.8% dividend yield might not sound exciting at first glance. But don't let that modest yield fool you. Lilly has been aggressively growing its dividend at a 15% rate over the past 5 years, with 10 consecutive years of increases. This isn't just a dividend payer. It's a dividend growth machine backed by revolutionary products. Looking ahead to 2025, the valuation story gets even more compelling. Analysts project earnings per share of $22.68, putting the stock at a forward PE of 34.3, slightly above its 5-year average of 33.9. But here's the kicker. With projected average growth of 50% over the next few years, Lilly's PEG ratio sits below 1. Making it an incredibly attractive growth opportunity at current prices. Wall Street sees this too, with an average price target of $1,060, suggesting a massive 36% upside from current levels. But what really sets Lilly apart isn't just the numbers, it's their position at the forefront of healthcare innovation. Their GLP-1 drugs aren't just another product line. They're revolutionizing the treatment of obesity and diabetes, two of the most prevalent chronic conditions globally. This isn't just a pharmaceutical play. It's an investment in the future of healthcare itself. With their robust pipeline and proven ability to execute, Lilly is perfectly positioned to continue delivering both growth and increasing dividend payments to shareholders. Number 4. AbbVie, ABBV. Next up in our powerhouse lineup is what I call the investor's trifecta. AbbVie, ABBV. With a market capitalization of $306 billion, this healthcare giant has mastered the rare combination of growth, value, and income that dividend investors dream about. Here's what makes AbbVie's story particularly fascinating. Despite all the market volatility, the stock has climbed 12% over the past year. But the real story lies in what happened next. AbbVie was actually soaring past $200 per share, until a mid-November surprise that most investors misunderstood. The company missed a target in trials for a new schizophrenia drug, sending shares tumbling. But here's what Wall Street is missing. This is exactly the kind of short-term thinking that creates opportunities for smart dividend investors. Let's talk numbers, because they reveal AbbVie's true strength. Their operating margins stand at an impressive 26%, with EBITDA margins of 33%. But here's the number that should really grab your attention. Their free cash flow margin sits at a staggering 40%. Think about that for a moment. For every dollar of revenue, AbbVie generates 40 cents in free cash flow. That's not just efficient. That's a cash-generating machine. Now, let's address the elephant in the room. Yes, AbbVie lost patent protection on Humira, the world's top-selling drug, in 2023. But here's what makes this company special. They saw this coming years ago and executed a masterful transition plan. Their new stars, Skyrizi and Rinvoq, aren't just replacement products. They're potential blockbusters in their own right, with a long runway for growth. The dividend story here is simply exceptional. AbbVie currently offers a hefty 3.78% yield, the kind of income that gets dividend investors excited. But it gets better. They've been growing this dividend at an 8% rate over the past 5 years, with 11 consecutive years of increases. And given their robust free cash flow generation, there's plenty of room for future increases. Looking ahead to 2025, the valuation becomes compelling. With projected earnings per share of $12.14, the stock trades at a forward PE of just 14.1 times. That's above their 5-year average of 11 times. But here's the key insight. AbbVie is transforming into a more diversified, stable company, deserving of a higher multiple closer to peers like Amgen and MC, which trade at 15 times earnings. Wall Street seems to agree with an average price target of $206, suggesting over 20% upside from current levels. What truly sets AbbVie apart is their proven ability to navigate major patent cliffs while maintaining growth and shareholder returns. This isn't just another pharmaceutical company. It's a shareholder-focused operation that's masterfully balanced growth investments with generous shareholder returns. Number 5. Merck & Company, MRK. Let's dive into our next powerhouse pick. Merck & Company, MRK, a healthcare giant that's been unfairly punished by short-term market thinking. With a market cap of $258 billion, Merck isn't just another pharmaceutical company, it's a global healthcare innovator that's currently offering investors a rare combination of growth, value, and income. Here's where the story gets interesting. Merck's stock is down 5% over the past 12 months, and even more dramatically, it's fallen more than 20% in just the last 6 months. Now, here's the plot twist that most investors are missing. This sell-off started after their Q2 earnings report in July. The irony? They actually beat both top and bottom line expectations. So what happened? Let me share a crucial investing wisdom I've learned over years of market analysis. Wall Street often cares less about what you did and more about what you're going to do. When Merck lowered their forward guidance, the market threw a tantrum. But here's where smart dividend investors see opportunity. This reaction looks increasingly like a serious overreaction. Let's talk numbers, because they tell a story of impressive growth and execution. Over the past 3 years, Merck has grown revenues from $48.7 billion to $63.2 billion. Operating income has expanded from $13.2 billion to $14.2 billion. But here's what really matters for dividend investors. They're maintaining robust operating margins of 22% and converting 23.5% of revenue into free cash flow. That's the kind of financial strength that supports sustainable dividend growth. Speaking of dividends, Merck currently offers a compelling 3.2% yield, significantly above market averages. But it gets better. They've been growing this dividend at an 8% rate over the past 5 years, with 14 consecutive years of increases. This isn't just about current income, it's about growing income. Now let's talk valuation, because this is where it gets really interesting. Looking ahead to 2025, analysts expect earnings per share of $9.49. At current prices, that puts the stock at a forward PE of just 10.5 times, remarkably below their 5-year average of 15.4 times. Wall Street analysts see this disconnect too, with an average price target of $130, suggesting nearly 30% upside from current levels. Yes, there's the patent cliff coming for Keytruda in 2027, their mega blockbuster cancer drug. But here's what the market is missing. 2027 is still years away, and Merck's proven track record of innovation and pipeline development suggests they're well-positioned to navigate this transition, just as they've done before. Number 6. L3. Harris Technologies, LHX. Now let's shift gears from healthcare to what might be one of the most strategically positioned defense contractors in the market. L3 Harris Technologies, LHX. With a market cap of $42 billion, L3 Harris isn't just another defense company, it's a technological powerhouse that's revolutionizing modern defense systems. Here's where the story gets fascinating. While the stock is up 6% over the past 12 months, there's been a dramatic plot twist since the recent election. L3 Harris has fallen 16.5% since election week, creating what might be one of the most compelling buying opportunities in the defense sector. But here's what makes this situation particularly interesting. This sell-off is based on a fundamental misunderstanding of defense spending dynamics. Let me explain why the market's got this one wrong. Yes, there's speculation about Trump 2.0 pulling back on wars and defense spending. But here's the crucial detail many investors are missing. During Trump's first term, defense spending didn't just increase, it saw significant expansion. This disconnect between perception and historical reality is creating a unique opportunity for dividend investors. Let's dive into the numbers, because they tell a story of impressive growth. Over the past 3 years, L3 Harris has grown revenues from $17.8 billion to $21.1 billion, representing a solid 19% growth. Now, while operating income has held steady at $2.1 billion, this actually showcases a crucial transition. The company is actively prioritizing cost savings and operational efficiency. With operating margins of 10% and free cash flow margins of 8.5%, they're generating the kind of consistent cash flow that dividend investors love to see. Speaking of dividends, here's what makes L3 Harris particularly appealing. They currently offer a 2.1% yield, backed by an impressive 10% 5-year dividend growth rate. Even more impressive? They've maintained 23 consecutive years of dividend increases. This isn't just about collecting dividends. It's about growing your income stream year after year. Looking ahead to 2025, the valuation becomes compelling. With projected earnings per share of $14.33, the stock trades at a forward PE of just 15.1 times, well below their 5-year average of 16.6 times. Wall Street sees this disconnect too, with an average price target of $283, suggesting nearly 30% upside from current levels. What truly sets L3 Harris apart is their unique position at the intersection of defense and technology. They're not just building traditional defense systems, they're developing the next generation of defense technology that will be crucial regardless of who's in the White House. Number 7. General Dynamics Corp. GD. Next in our lineup is another defense sector powerhouse, General Dynamics GD. With a market cap of $72 billion, this isn't just another defense contractor. It's a diversified industrial giant that's mastered both military and commercial markets in ways its competitors can only envy. Here's where the story gets intriguing. While GD is up 5% over the past 12 months, there's been a dramatic plot twist since election week, with the stock falling 177%. But here's what makes this situation fascinating. This sell-off represents a shocking misalignment between market perception and business reality. You see, General Dynamics isn't just about military contracts. They're the force behind the prestigious Gulfstream private jets, a business that's seeing explosive growth in both private and commercial aerospace sectors. Let me share something remarkable about their latest earnings that most investors missed. GD achieved double-digit growth across all categories. We're talking about revenues, operating income, and most importantly for dividend investors, free cash flow. Their Gulfstream aerospace segment and marine systems, think Navy contracts, aren't just growing, they're thriving. Looking at the numbers, General Dynamics has grown revenues from $38.5 billion to $46.1 billion in just 3 years. That's a solid 20% growth. Operating income has expanded from $4.2 billion to $4.7 billion, maintaining robust operating margins of 10% and generating impressive free cash flow margins of 9%. This isn't just growth, it's sustainable, profitable expansion that's powering shareholder returns. Now, let's talk about what dividend investors really care about: the payout. GD currently offers a 2.2% dividend yield, backed by a solid 7% 5-year dividend growth rate. But here's what's truly impressive. They've increased their dividend for 30 consecutive years. That's 3 decades of consistent dividend growth through multiple market cycles, economic downturns, and geopolitical crises. This isn't just a dividend stock, it's a dividend aristocrat in the making. Looking ahead to 2025, the valuation story becomes compelling. With projected earnings of $16 per share, the stock trades at a forward PE of 16.6 times, slightly below their 5-year average of 17.7 times. Even more interesting is their PEG ratio of 1.1, suggesting the stock is reasonably priced relative to its growth rate. Wall Street analysts see the opportunity too, with an average price target of $320, implying a 20% upside from current levels. What truly sets General Dynamics apart is their balanced approach to defense and commercial aviation. While others focus solely on military contracts, GD's Gulfstream division provides a crucial growth engine that's less dependent on government spending cycles. This diversification not only reduces risk, but also provides multiple avenues for growth, making it a compelling choice for dividend investors looking for both income and appreciation potential. Number 8. Coca-Cola Company. KO. Up next is a company that's not just a beverage maker, but a dividend royalty. Coca-Cola, KO. With a market capitalization of $272 billion, this consumer staples giant has been through what I'd call a market roller coaster that's creating an intriguing opportunity for dividend investors. Here's where the story gets fascinating. While the stock is up 6% over the past 12 months, Coca-Cola has weathered what might be one of the most interesting challenges in its 130-year history: the rise of GLP-1 weight loss drugs. But here's what makes this situation particularly compelling. We've seen this movie before. Just 18 months ago, when GLP-1 drugs first gained momentum, KO's stock took a hit. The market overreacted then, recovered, and guess what? We're seeing the same overreaction creating another brilliant buying opportunity. Let's dive into the numbers because they tell a story of remarkable resilience and adaptation. Over the past 3 years, Coca-Cola has grown revenues from $38.7 billion to $46.4 billion. That's a solid 20% growth. But here's what's really impressive. Operating income has surged from $11 billion to $13.5 billion during the same period. They're maintaining phenomenal operating margins of nearly 30% and converting 21% of revenue into free cash flow. That's not just efficient, that's a cash-generating machine. Now let's talk about what makes Coca-Cola truly special: their dividend legacy. The company currently offers a juicy 3.1% yield, with a 4% 5-year dividend growth rate. But here's the crown jewel. Coca-Cola is dividend royalty, having increased its dividend for more than 62 consecutive years. We're not just talking about a dividend aristocrat, we're talking about a dividend king. Looking ahead to 2025, the valuation becomes incredibly attractive. With projected earnings per share of $2.97, the stock trades at a forward PE of 21 times, notably below their 5-year average of 25.8 times. Wall Street sees this disconnect too, with analysts setting a price target of $75, suggesting a 20% upside from current levels. What truly sets Coca-Cola apart isn't just their brand power, it's their management's ability to adapt and innovate. While others panic about GLP-1 drugs, Coca-Cola's management is already executing a brilliant strategy, introducing more zero-calorie options, optimizing package sizes, and leveraging their unmatched distribution network to capture changing consumer preferences. This isn't just a company surviving change, it's a company that's been thriving through change for over a century. Number 9. NextEra Energy, NEE. Next up is a company that's redefining what it means to be a utility stock: NextEra Energy, NEE. With a market cap of $151 billion, this isn't your grandfather's slow-moving utility. It's America's largest power producer and a clean energy pioneer that's been outperforming even the mighty S&P 500. Here's what makes NextEra's story absolutely fascinating. Despite being up 19% over the past year, the stock has taken a 15% hit since Election Day. But here's where it gets interesting. While the market is fixated on potential policy changes under Trump 2.0 and its impact on clean energy initiatives, they're missing the bigger picture entirely. Let me share something remarkable that most investors overlook. When you look at NextEra's performance against the S&P 500 over the past decade on a total return basis, they've outpaced the index by an impressive 12 percentage points. For a utility company to outperform the broader market is rare. To do it by this margin is extraordinary. The numbers tell a story of explosive growth that defies utility sector norms. NextEra has catapulted its revenue from $17.1 billion to an impressive $26.3 billion in just 3 years. That's a stunning 54% growth since 2021. But here's what's even more remarkable. Their operating income has skyrocketed from $2.9 billion to $8.5 billion over the trailing 12 months. With operating margins of 32% and free cash flow margins of 21%, they're generating the kind of profits usually associated with tech companies, not utilities. Now, let's talk about what makes NextEra a dividend investor's dream. They currently offer a solid 3% yield, but here's the kicker. They've been growing this dividend at a 10.5% rate over the past 5 years, with nearly 30 consecutive years of increases. This isn't just a utility dividend, it's a growth machine masquerading as a utility stock. Looking ahead to 2025, the valuation becomes incredibly compelling. With projected earnings per share of $3.68, the stock trades at a forward PE of 19.8 times, dramatically below their 5-year average of 30.3 times. Even more telling, their decade-long average multiple has been closer to 25 times. Wall Street sees this disconnect too, with a consensus price target of nearly $90, suggesting a 22% upside from current levels. What truly sets NextEra apart is their perfect positioning for the future of energy. While others worry about clean energy policies, NextEra is focused on a more fundamental truth. America's power grid is being stretched to its limits. With the explosion of AI, data centers, and supercomputers, the demand for reliable power isn't just growing, it's accelerating. NextEra isn't just ready for this future, they're building it. Number 10. ExxonMobil, XOM. Let's wrap up our powerhouse lineup with a true energy sector titan. ExxonMobil, XOM. With a massive market cap of $487 billion, Exxon isn't just another oil company. It's an integrated energy empire that's mastered both upstream and downstream operations, giving investors exposure to everything from oil exploration to refined products. Here's what makes Exxon's story particularly compelling right now. Despite being up 7% over the past 12 months, we're seeing a perfect storm of opportunity forming. Right now, we're sitting at a fascinating junction in energy markets. Crude oil prices are hovering near their yearly lows due to higher supply and lower demand concerns abroad. Even more interesting is the natural gas situation. 2024 prices have plunged to levels we've only seen twice in the past decade, once in 2016 and during the 2020 pandemic. But here's what smart investors understand. These low prices aren't a weakness. They're creating a massive coiled spring for future growth. Let me share something most investors miss about Exxon. Their integrated business model is a masterclass in resilience. When you invest in XOM, you're getting both upstream, exploration and production, and downstream, refining and retail operations. Think of it as built-in diversification. Their numbers tell this story perfectly, growing revenues from $276.5 billion to nearly $340 billion over 3 years, representing 23% growth. Operating income has surged from $24 billion to $40.3 billion, with operating margins of 12% and free cash flow margins of 10%. Speaking of value return, Exxon is running what I call a double-barrel approach to shareholder returns. First, there's their impressive 3.6% dividend yield, the highest in our entire lineup. While their 5-year dividend growth rate sits at 2%, they've increased this dividend for more than 25 consecutive years, earning them the coveted dividend aristocrat status. But here's the kicker. They're also running one of the most aggressive share buyback programs in the market, effectively giving shareholders 2 ways to win. Looking ahead to 2025, the valuation becomes incredibly attractive. With projected earnings per share of $8.25, the stock trades at a forward PE of just 13.2 times, well below their 5-year average of 15.2 times. Wall Street sees this disconnect too, with an average price target of $131, suggesting more than 20% upside from current levels. And while we're bullish on Exxon, it's worth noting there are other compelling plays in the energy sector. Companies like Sierra and Kinder Morgan Phillips offer interesting alternatives, but Exxon's scale, integration, and shareholder-friendly policies make it our top pick in the space. After deep diving into these 10 dividend powerhouses, let's put it all together and see just how compelling this portfolio really is. When you combine these selections, you're looking at an average dividend yield of 2.4%, significantly higher than the S&P 500's current yield. But here's what makes this portfolio truly special: the combined upside potential of over 20% according to analysts' consensus targets, plus the robust dividend growth rates that range from 2% to 15%. But this isn't just about the numbers. What we've carefully constructed here is a strategically diversified portfolio that's positioned to benefit from multiple major trends: the AI revolution with Microsoft and Taiwan Semiconductor, the healthcare transformation with Eli Lilly, AbbVie and Merck, the defense sector's technological evolution with L3Harris and General Dynamics, and the energy transition with NextEra and ExxonMobil. Meanwhile, Coca-Cola provides that rock-solid consumer stability that every portfolio needs. Now, let's talk about your next steps. Here's exactly what you need to do. First, consider your entry points carefully. While all these stocks are attractive at current levels, you might want to scale into positions gradually, especially in more volatile names like Taiwan Semiconductor or Eli Lilly. Second, think about position sizing. Given the higher growth potential in technology and healthcare names, you might want to allocate slightly larger portions to these sectors while using the utilities and consumer staples as your stable foundation. Finally, make sure to subscribe to our channel and hit that notification bell. I'll be providing monthly updates on these picks throughout 2025, including any major developments, earnings analysis, and potential changes to our thesis. Remember, building generational wealth isn't about getting rich quick. It's about making smart, strategic investments in quality companies and letting the power of compounding work its magic over time. These 10 dividend powerhouses are your foundation for that journey.